Howdy, Jacob here. Today we're looking at Avanos Medical, company 67 of our generic stock screener. In the healthcare equipment industry is 916 million market cap on just over $1 billion enterprise value. Let's see what that insider ownership is. 2.9%. So they do have a little bit of money invested in the company, but not so much that you're extraordinarily confident they're going to do what's best for you as a shareholder. But I do think that is still positive, and you just have to see whether it's making sure that the person holding the investment is someone who can actually make a difference. And so that's just one statistic to look at. But revenue, I think there's a huge sell-off in 2015, which you can see revenue declined 70%. But since then, you're looking at about 2% CAGR over the last 8-9 years. With gross margin increased quite a bit from that sell-off, so it could have been a good sell-off. But from the operating margin standpoint, it's actually they went from 5% to negative. That's kind of interesting, with return on invested capital in the low single digits. Let's look at this. Cost of goods sold dropped off like crazy, and more so again than revenue, because we see 1,100 drop off in revenue and only less than 900 drop off in cost of goods sold. So we do see a very positive we see a positive impact to gross profit. But their sales in general, R&D, their other expenses didn't change. So now they make way less money on almost the same of the operating expenses. So not entirely positive, but shares are relatively flat, so they haven't been diluting the shareholders at all. Not much. 88 million cash on hand with 159 million in long-term debt. So not terribly concerned with that. That's about 100, let's just say 100, let's round up, of their net debt, and 5-year true cash flow of maybe 30 million. So I mean, it's very cyclical. Their earnings are very volatile, but their free cash flow is very volatile. But I'm glad that it's more positive than their net income. So that's a good sign. And the use of their free cash flow, some acquisitions, some share repurchases, reduction of debt. So not terrible use of cash flows. Let's start making some assumptions based on what we've seen so far. So from the revenue perspective, I think I feel pretty comfortable going with 3. Just pretty much right in line with inflation, slightly below average. Price to earnings, terminal price to earnings, and free cash flow. I think I'm just going to roll with the averages here because we saw that their margins are very volatile, and then share change, maybe keep that flat. 15 million stock-based compensation. Let's say they just offset that, keep it flat, and yeah, it needs to fall 86% to get to the return I'm looking for here. I mean, again, these types of businesses are, the balance sheet is 0.7, so, but 796 million is on goodwill. So, these types of businesses are valued on price to earnings, price to free cash flow, and it's just the present value of all the earnings that you expect prospectively. And right now, I just don't think that the cash flow you're going to be receiving is going to be worth what you're buying for today, personally. But I do hope you enjoy the video. Here's today.